Our first question comes from Jorge Kuri with Morgan Stanley. Your line is now open.
Hi, everyone. Good morning. Could I ask you to please explain what exactly happened with those FX limitations that you had in Argentina? What is the temporary nature of them? It just doesn't feel that it's going to get much better with CPI at triple digits, central bank rates probably a triple digit soon, the government running out of FX reserves. What exactly happened? What gives you comfort that this is not going to be a recurrent issue, at least until things improve in Argentina? And also, if you can tell us, what would have been your revenues excluding this effect? Because we did see a significant deceleration of your revenue growth. You grew 15% sequentially in the first quarter, 16% sequentially in the second quarter, and then we're down at 11% this quarter. And so want to understand how much of that deceleration was because of this Argentina issue. Thank you.
Jorge, good morning, and thanks for the question. So, Diego, I'll start, but feel free please to complement. So, Jorge, we've been navigating a complex situation in Argentina from the beginning of this current quarter. If anything, what we've seen is that typically in Argentina, things get tougher at first, and then as months or as weeks go by, there's more clarity around the local frameworks. If anything, we see everything trending on the right direction. Obviously, Argentina, it's a complex country. It represents, as no other country of ours, it's not a big portion of what we do. But we also, Jorge, know that deal with complex geographies, and part of the value that we bring to the table is continuing to navigate countries and situations like this. We've been in Argentina from 2016. We've been through ups and downs in all the creativity that the local government have had, and so far we've been able to navigate it. If anything, we are very comfortable today because we've seen things trending in all the right directions also coming into Q4. Had it been for the Argentina growth, we probably could have added 4 to 5% more in revenues. But Jorge, I need to emphasize that we are extremely proud with the growth numbers we've shared today. Our Africa and APAC business is booming, and we think that's a key factor going forward. We continue to not have reliance on any particular geography. And situations like this, like the one we face in Argentina, will happen in emerging markets. It's expectable. We have 39 countries where we operate today. It's only to be expected. But what's really important is our resilience, our understanding, our deep understanding of the local regulatory framework. And most importantly, from the moment these things happen, how we navigate them and how do we ensure continuity to our merchants, which is something we are very happy to be able to maintain for the most part. Diego, feel free to complement if there's anything you want to add.
Okay. From my side, the situation is substantially normalized by the end of the quarter. So, we adapted, and the banks adapted, and the central bank adapted to these regulations. There were several changes during the quarter, from the beginning of July to the end of September. In general, the first one were, negative, and then they adapted to more positive. But also the banks take time to adapt to these regulations, and we face those challenges as we faced many times. And we start Q4 in a much better position and growing from there.
Thanks for that. I mean, I appreciate that the company is resilient and that you adapt to changes. And I would really want to know exactly what happened. I'm not sure that the response was clear. What exactly happened? How did it limit your ability to grow your revenues? And what exactly is happening now that you feel that the situation has been normalized? If you can just be a bit more clear so we can understand exactly the issue. Thank you.
Sure. Okay, so typically when the Argentina government comes up with new regulation around FX, they come up with a very blanket regulatory framework where they say all of these industries are now restricted. In our experience working with the local central bank, they typically want to preserve the ability for global companies that are key to the population to access dollars. We are speaking about our merchant base, who you know very well. So these are key services for the local population. So typically what happens is, while the initial regulatory change is very tough, you see it flexibilizing over the weeks and months. There's also what Diego was mentioning. There's also some time, Jorge, that it takes for banks to understand the new regulation and therefore navigate it. So our expectations is that things will continue to evolve in Argentina. Obviously, it's a very volatile country. It doesn't represent much of our business. It's part of our business model to be able to navigate this stuff. And the reason why we are more confident is because we are speaking from facts. The last week of Q3 was 100 times better than the first week of Q3, and therefore we are seeing the trend. And we're very comfortable going into Q4 and next year that things will continue to be doable for our merchants.
Thank you.
Please stand by for our next question. Our next question comes from Tito Labarta with Goldman Sachs. Your line is now open.
Hi, good morning. Thank you for the call and take my questions. A couple questions, if I can. Maybe, first, just a quick follow-up on the question on Argentina. Are you able to price for that? So, maybe because of these issues, you increase the take rate, just to try to say if there's any offset given these issues that you face there. And did this also impact your financial costs? Your financial costs kind of went up a lot in the quarter. Just I think you mentioned related to hedging or so. Just if you could give some more color on that. And then I have a second question, but I'll ask after.
Sure. Tito, thanks. Good morning, and thanks very much for the question. I'll start with the first part, and I'll let Jaco cover the second. Yes, our price always reflects complexity. In countries that are easier to navigate, we typically have lower take rates. In countries where there's volatility and where there's regulatory frameworks that are challenging, typically you see our take rates being higher. It's just a function of the complexity we're solving for our merchants. So yes, we typically have the ability of having higher take rates in markets that are more volatile, like this case. Jaco, do you want to complement?
Sure, Tito. Thanks for the question. So regarding financial expenses and related to this particular change in regulation, yes, part of Q3, we have incurred into high cost of hedges because of the change in regulation. We see these being temporary changes, which we need to incur extraordinarily in order to cover our positions. As we have always been saying, we take a very conservative approach towards FX. We have never been in the business of taking credit risk, so that's why we hedge non-dollar amounts. If anything, we expect in the coming quarters this cost to get again normalized going forward.
Great, thank you. That's helpful. And my second question, more on the net revenue retention rate. You continue to be above the 150 plus that you've guided for. Maybe if you don't have these issues in Argentina, it could have been close to where you were in QQ. Just to think about the trajectory from here. You're seeing very strong growth in Asia and Africa. Any color you can give on either 4Q, but even beyond, like into next year, should we expect continued deceleration on the net revenue retention rate? Anything that can drive increase it from here? Maybe some seasonality in 4Q and any color on 2023 would be helpful. Thank you.
Sure. So, Tito, we've had a very tough comp, and we are extremely proud of the 152 we've just posted. We've remained very consistent, and we've guided you to 150 plus for the year, and we are very, very confident that that's going to be delivered. We've never had a better business. All of the growth engines in the company, from strategic standpoint, from a commercial standpoint, continue to be at full throttle. So we are extremely optimistic on what's going to come for Q4 and 2023. We are taking the advice from the street and trying to give you some more clarity on how we're going to navigate 2023, on how we're going to guide for 2023, but we are extremely, extremely optimistic in terms of what's going to come for Q4 and the future years. We've never been a better company. I know I repeat this again and again, but we never had more products. When you see countryside merchants, when you see geographic diversification, everything points into the right direction. Those things are long-term building blocks that we are happy to have in place today. So very optimistic for Q4 and very optimistic for 2023 as well.
Great. Thanks, Sebastian. Maybe just some quick follow-up on that. In terms of what gives you that optimism? Is it the growth you're seeing in Asia and Africa? Is it maybe Argentina coming back to some extent? Because particularly a lot of these global online merchants having a tough time in some of their local markets, but maybe there's still a lot of growth in developed markets. Just any color on what makes you so optimistic?
Sure. So, Tito, in Latin, we are clear market leaders, and we think that differentiation is going to continue to compound. We have a clear moat where the biggest merchants rely on us for the most complex operations in these countries, and we think that's going to continue to evolve. Obviously, Africa and APAC have been a great story for ourselves. When we went public, we told you we wanted to do this. That has become a clear reality. We have a run rate of $100 million outside of Latam. So Latam is going to continue to be our stronghold, our part of our growth engine, but having that complemented with our strategy across other emerging markets continues to be key. So overall, we cannot avoid being positive. Our pipeline is healthier than ever. Merchants rely on us on more geographies, for more payment methods, and those are all the key things that drive value. We know we need to solve complex problems for our merchants, and we feel we are solving more and more than ever. So it's impossible for us not to be very bullish. And the other thing, Jorge, Tito, I know there's some of these merchants are going through a very tough micro environment, but emerging markets have proven to be a growth engine for them. We fall right into that strategy. And if anything, you've seen many of them doing layoffs. And what we've seen in the past is that when layoffs happen, typically our services become more needed because they do outsource more of that work for us. So all of those trends are for us in the right direction. And I want to emphasize that we are very optimistic.
That's great color. Thanks, Eva.
Please stand by for our next question. Our next question comes from Tyler DuPont with Bank of America. Your line is now open.
Hi, this is Jason Kupferberg from Bank of America. Can you hear me?
Hi, Jason. Good morning. We hear you.
Good morning. Thank you. Now that Q4 is halfway over, I assume you have really good visibility here in the near term. I mean, just as a general frame of reference, should we assume that the full year guidance for both NRR and adjusted EBITDA margins is valid for Q4 specifically?
So, Jason, we've never updated our guidance. We haven't done it in Q1. We haven't done it in Q2. We are not going to do it this time. I think the color that is important to share is that everything is trending on the right direction. We've seen nothing that makes us worry in the short term. We continue to see positive underlying growth in our business. So there's no reason why we shouldn't be able to continue to deliver on those numbers.
Okay. Understood. And just given the explosive growth you've seen in Asia and Africa, can you talk about any notable differentials in either gross or net take rates in those geographies relative to LATAM? And then anything you're seeing just in terms of your merchant clients setting up local legal entities more frequently to turn cross-border transactions into domestic? Thank you.
Sure. Jaco, do you want to take it?
Sure. So Jason, hey. Hi, hello. Thank you very much for the question. So we are super positive with the steps we have been giving towards Africa and Asia. The two regions have become very relevant to us. In terms of net take rate, it's still too early to define. It depends on the payment mix, on the countries where merchants are going to be penetrating. If anything, we see merchants trusting us more and more in our service in both geographies, and we don't see them going by themselves with local entity. Quite on the opposite direction, penetrating these two complex regions. They prefer to do it in partnership with us, so we remain very, very optimistic on the step we have been giving towards those two new geographies for us, and that has been translating to the revenues we are posting for this quarter into the two geographies. Another thing to add is we are agnostic. We are agnostic to the payment method and to the type of service for our merchants. We are agnostic either if they are local to local or cross-border. We are able to offer both types of services to our merchants, and that's, if anything, give us the chance to have the merchants more locked with us into more geographies, and that's the reason why most of the merchants never graduate from us.
Okay, thank you.
Please stand by for our next question. Our next question comes from Sumit Datta, New Street Research. Your line is now open.
Hi there. Thanks very much. A couple of quick questions, please. Again, firstly, just returning to Asia and Africa, very good performance. I mean, you kind of almost doubled your revenues in the third quarter. So again, just not to try and ask the same question again, but just curious, was there anything in particular in this quarter which was kind of happening? Countries coming online, a couple of merchants here or there. Is this the kind of run rate we should expect going forward? Just such a strong performance. And then secondly, on a related basis, please, I'm just curious, what kind of card volumes or mix of card versus non-card are you seeing in these newer markets? I would assume there's less card volumes, and just wondered if that was having any impact on the economics of these transactions. Thanks very much.
Hi, and thanks very much for the question. So what has happened in both Africa and APAC is what we expected to happen, which is one API, one contract, and us being able to bring our global merchants into the new region. 9 out of our top 10 merchants use us today in Africa and APAC. The opportunity ahead is massive. We've been bullish in these regions, and we continue to believe that they're going to be a huge growth driver for us. We are not updating any guidance because that's not what we've done as a practice. But we believe that there's plenty of opportunity ahead. Jaco can complement on that. Jaco has been spending his time in South Africa and can give you a much better view. And in terms of cards, the expectation, what we've seen is very similar to what we've seen historically in other markets in LATAM. Some countries are card heavy, others are not that relevant. We, as Jaco was mentioning before, we are payment method agnostic in the sense that we need to offer whatever payment method users want to pay with, and we intend to continue to do so. Keep in mind, typically our net take rates reflect our cost of processing, so we shouldn't expect significant differences between one payment method and the other. Jaco, if you want to complement on the growth drivers for Africa and APAC, go ahead.
Sure. So I think overall it's echoing what Seba was saying. The fact that we have a single API and we have there are a lot of analogies between the service we have been providing Latin America and the opportunities there are in Africa and in Asia, and we have been able to replicate our playbook in LATAM in those two continents, and the merchants, they value a lot the fact that that playbook is constant, and the same API and the same agreement allow them to test our service and trust on our service in the region faster than doing any other solution before. So being able to understand the complexity in Nigeria and the relevance of Verb as a payment method, or the relevance of M-Pesa in Kenya, or for in Egypt, or cards and credit and debit cards in South Africa, same as we have done with UPI in India. I think that gives us leverage to cross out to a merchant and to get the return on our investments for the country, for the region.
Okay, thank you.
Sure.
Please stand by for our next question. Our next question comes from Andrew Bach with SMBC. Your line is now open.
Hey, good morning, team, and thanks for taking the question. You spoke to the success within your top 10 merchants being a derivative of new product innovation and adoption of some of your solutions. So maybe you could provide everybody with some specific examples on things that you're doing now within that base that you may have not been, last year or the year before that.
Sure. Hi, Andrew. Good morning, and thanks for the question. So I think it's always a matter of product innovation plus skill. So things like credit card acquiring in Nigeria, or the acceptance of UPI, as Paco was mentioning, in India, or some of the wallets we've been able to offer in Indonesia, or being able to pick and do cash collections in Egypt. All those small things compound. In payments, innovation comes in small incremental steps, and having a valued solution means that you are solving multiple problems for your merchants at the same time. So those are the unsexy things that compound and allow you to differentiate on a daily basis. That's what our product and engineering team are constantly evolving. And then there are things that have more skill and are easier to point out to. Things like marketplaces, where we use the technology we have for payments and payouts, and we mix it together to allow marketplaces, which is many sellers and many buyers at the same time. Those complexities, when you add them up to the local regulatory framework, to the local payment methods, are things that allow us to differentiate. We are doing what we've always done at a much bigger scale, and we are able today to provide the building blocks for our merchants to be creative. Some of them want to do just-on-time payouts, and that's something that requires deep infrastructure, connections with every single bank, and that's a hard work that we've been investing on for many years now, and that's how we differentiate. So there's no results, there's no gold bullets. It's continuous incremental innovation, and that's what we are determined to do.
Got it.
Just an additional metric. Last year, the top merchants were in 5 countries. 5 of them were in Asia and Africa with us, and this year, this quarter, 9 of them are already in Asia and Africa with us. So basically, our merchants are growing and expanding with us to these markets.
Nice to see that geographic expansion. Your headcounts stepped up pretty considerably over the last couple of quarters. Just trying to get a sense of the pace of hiring that you guys anticipate over the next year, even as the world becomes more uncertain. Should we anticipate that level of new heads to come onto the platform in the coming year, or should you expect to slow down? Any additional insight there would be much appreciated.
Sure. So, Andrew, we've always operated with a small team. 700 people for the size of our business is considerably smaller than what you see other companies at our scale operating with. We intend to continue to do so. This is the time for us to invest. The opportunity is massive. Our business has shown to have already operating leverage. So it's very clear that it's the opportunity for us to invest. We don't foresee, and we've never had hiring targets. We never set ourselves a number of people we want to hire. We make sure we have the right culture in place. We really care about being profitable, growing fast, and being lean. Keep in mind, we bootstrapped dLocal for the first few years of our history, and that DNA has become really deeply ingrained. So we are always going to be a company that's going to be extremely cautious in terms of how we spend. We believe there's a massive opportunity ahead of us, and we want to be able to invest against it. But we're also big believers in small teams. We believe that small teams with greatly talented people aligned with the right culture can achieve amazing things, and that has always been the formula for us. And if anything, that formula is now more impactful or relevant than ever.
No, absolutely.
As a reminder, please press star 11 on your telephone to ask a question. Please stand by for our next question. Our next question comes from Leonardo Lee with UBS. Your line is now open.
Hey everyone, it's Caio Prata from UBS here. Thanks for the opportunity for asking a question. I have one follow-up in terms of DNA. If we take a look on your DNA expenses, we had actually a relevant increase in a quarter-over-quarter basis of more than 25%. So I understand that you continue to hire more people, but I also see that it also happened like in the last quarter. So just would like to have a sense about what caused this massive increase during this quarter and what can we expect going forward, especially for the fourth quarter. And just to complement, if you are now more comfortable to say that you will be able to maintain this level of 37, 38% EBITDA margin also in the fourth quarter, and if not, where can we see any type of pressure going forward? Thank you.
Diego, do you want to take it?
Yeah, sure, Seba. So particularly in the third quarter, we have mid-year salaries increases. We also had some additional professional expenses and one-off technology expenses. So there were specific situations, I would say, in Q3. Going forward, we see a lot of operating leverage. As Seba mentioned, we will continue growing headcount, which is our main line of expenses, particularly in technology, sales and marketing, and expansion. But most of all the other areas, corporate areas like staff, finance, compliance, and so on, are in a much more mature and sophisticated stage. So we expect those ones to scale quite a bit going forward.
Okay, thank you. In terms of the EBITDA margin?
What is the question? Sorry.
So just to complement, like now that we are like in the middle of the fourth quarter, and having said that, you hired like most of the people already for this year, can we maintain this level of 37-38% margin for the fourth quarter as well? And if not, where can we see any type of pressure?
Sure. So we give annual guidance, so we're not giving guidance per quarter. As we mentioned, all the strengths continue in terms of growth. As I mentioned, we have an increase in OpEx in per quarter, but we don't expect that type of increase in the coming quarter. We expect operating leverage going forward. We will guide for a new EBITDA margin level in the next year, but these are the trends that we are seeing right now.
Sorry, and Caio, just to complement on that, we believe we are already very profitable. We are generating cash. The opportunity ahead of us is massive, and we believe it's important for us to have enough dollars to invest. We've clearly shown that when we invest, there's a clear ROI. We've been good guardians of capital, and we intend to continue to be so. We're not going to splurge. We want to continue to be very lean, but whenever we see an opportunity for growth, for investment in growth, we want to continue to pursue it because we think that's the long-term path for us. And we are very excited about our prospects. We don't think it's time now to optimize for half a point here or there in the EBITDA. We really care about having the right investments in place, making sure that those drive growth. And then we know, because we've seen it, that our business has significant operating leverage.
Okay, great. Thank you, Stefan and Diego.
At this time, I show no further questions. I would now like to turn the conference back to Sebastian Kanovich, CEO, for closing remarks.
Thank you very much. So I don't want to be repetitive, but I want to say we are extremely proud with the results we posted this quarter, and we are extremely excited about the opportunities that we see for the company, both in Q4 and for 2023. Our strong performance here today has shown that the strategic decisions we've made in the last year, together with a very strong execution, are putting us on a great position. So I want to emphasize that we are very bullish for Q4 and for 2023. I really appreciate all of the questions, and thanks very much.